Goldman Sachs has just published its most comprehensive outlook report yet, spanning over 100 pages of analyses, graphs, and forecasts for 2026 and the years beyond. Almost immediately, headlines surfaced everywhere, suggesting Goldman was forecasting a market collapse. Financial influencers began to circulate videos with sensational thumbnails, and panic quickly spread across comment sections. But there's a catch. This isn't what the report actually states. Over the past week, I meticulously reviewed each page of this report, cross-examining their data to differentiate between Goldman's actual predictions and the sensationalized narratives promoted by clickbait creators. What I discovered is far more intricate and beneficial than either the manic pessimists or eternal optimists would like to acknowledge. The truth is, Goldman Sachs is not forecasting a market crash in 2026. Instead, they're anticipating something potentially more challenging for most investors to navigate, something requiring a whole new strategy compared to the last 15 years. Today, I'll guide you through what Goldman's report truly outlines, the specific risks they've highlighted that most coverage overlooks, and crucially, what this means for your finances in 2026 and the upcoming decade. Let's start with what the report explicitly mentions about 2026. Titled U.S. Resilience Resilient, the report itself provides a clue. This isn't a doomsday document. It argues that despite substantial risks, the American economy and stock market have shown outstanding resilience and are likely to continue doing so. Their primary forecast for the S&P 500 in 2026 is a 7% return. Not a crash, not stagnation, but a robust 7% increase. Let me explain how they reach this figure, because the details are important. Goldman anticipates 11% growth from corporate earnings and dividend yields, as American companies consistently generate notable profits. The expansion of artificial intelligence infrastructure continues to boost spending, and consumer spending remains strong. These primary drivers result in substantial growth in the intrinsic value of American enterprises. However, Goldman then deducts 4 percentage points from that 11%. Why? They foresee a decrease in price-to-earnings ratios. Stocks are currently costly, and Goldman believes some of this premium will diminish throughout 2026 as valuations gradually normalize. The equation is simple. 11% fundamental growth minus 4% valuation compression equals a 7% expected return. This is their base scenario for 2026. A 7% return might be lower than the historical norm, but it remains positively strong. It's not the overwhelming growth seen in 2023 and 2024, but it's far from the crash suggested by some headlines. Goldman also estimates the chance of a recession at approximately 25%, meaning they expect a 75% chance of continued economic growth. This isn't an insignificant risk, but it's also not a 50-50 chance or an imminent collapse prediction. So why are many assuming Goldman is predicting a disaster? The confusion stems from a separate Goldman report released several months earlier. In October 2024, they presented a long-term forecast predicting the S&P 500 would yield only 3% annually over the next decade. This figure generated widespread media attention and continues to fuel crash-related narratives. Here's what most overlook. The 3% projection pertains specifically to the S&P 500, influenced by concerns of market concentration and elevated valuations. Goldman's global equity outlook was higher, at 7.7% annually, and even their conservative U.S. forecast indicates below-average returns, not negative ones. More crucially, Goldman explicitly mentions that low expected returns do not signify an impending crash. Markets can remain overpriced for several years while still producing positive returns. Transitioning from high to fair value doesn't necessitate a crash. It can occur through years of moderate gains as earnings catch up to prices. Let's explore what Goldman's data indicates about pricey markets. The report includes an intriguing chart showcasing market returns from various valuation starting points. They categorize historical times into deciles based on stock valuation at those periods. In the 1990s, the market ascended to the ninth valuation decile, indicating stocks were pricier than 90% of historical observations. What followed? The market surged by another 342% before the eventual correction. Between 2015 and 2017, valuations again reached the ninth and 10th deciles. Poor forward returns were anticipated, but what transpired instead? A 200% gain followed the COVID outbreak. Despite operating within the ninth valuation decile, the market managed another 100% increase. Goldman's data suggests that elevated markets can stay that way and continue to climb over prolonged periods. High valuations are a risk factor, but not a crash catalyst. The precise timing of returning to historical norms remains uncertain. This does not mean valuations are immaterial. For lengthy durations, initial valuations are a strong predictor of returns. However, the key term here is lengthy durations. Attempting to anticipate a market correction purely on valuation grounds has been ineffective for decades. Now, let's delve into the genuine concerns regarding valuations, as they certainly exist. The cyclically adjusted price to earnings ratio, known as the CAPE or Shiller PE, currently hovers around 39 to 40. For context, the historical average stands at around 17, more than double the long-term average. This marks only the second instance in 155 years of market history where the CAPE has surpassed 40, the first being during the dot-com bubble in 1999 and 2000. Understandably, that comparison causes unease, since the dot-com crash resulted in trillions of wealth loss and required 13 years to recover from the peak. Nonetheless, Goldman's analysis suggests that this comparison is inaccurate for several reasons. Firstly, the index's composition has shifted significantly. Today's leading companies are highly profitable, boasting strong balance sheets, robust competitive advantages, and substantial free cash flow. The dot-com leaders were frequently unprofitable, valued on expectations rather than fundamentals. Secondly, profit margins have experienced structural growth. Modern American firms generate higher margins than historical averages, partly due to the transition to asset-light technology enterprises. Higher margins can rationalize elevated valuations. Thirdly, interest rates play a role in valuations. When bonds yield nothing, stocks are warranted higher valuations as the sole source of substantial returns. Although rates have moved from zero, they remain below historical standards. In conjunction with inflation, Goldman's perspective is nuanced. Valuations pose a headwind for future returns, but aren't the foremost concern. They anticipate valuations will slowly contract, reducing returns over time, rather than sparking a sudden collapse. Moving on to market concentration, Goldman identifies this as a more pressing issue than most investors realize. The top 10 stocks in the S&P 500 now comprise over 40% of the index, a record concentration, even surpassing the dot-com peak. Consider this. If you hold an S&P 500 index fund, 40 cents of every invested dollar is tied up in just 10 corporations. The remaining 490 companies share the other 60%. The Magnificent Seven, dominant tech firms, alone constitute about 35% of the index. NVIDIA, a singular entity, represents nearly 7%. Goldman's studies show historical high concentration levels reliably predict decreased forward returns and escalated volatility. When an index is dominated by a few names, its performance hinges on those specific firms, rather than the broader economy. The concern isn't the caliber of these businesses, they're outstanding. The issue is that concentration breeds fragility. Any company specific issue reverberates through supposedly diversified portfolios. For instance, if spending on artificial intelligence falls below expectations, the hyperscalers, AI infrastructure builders, comprise a disproportionate share of the index. A shift in AI perspective could spark market wide selling, despite most companies being unaffected. Goldman stresses that concentration itself doesn't instigate crashes, but magnifies subsequent moves, whether positive or negative. Today's market is likely to react more aggressively in either direction compared to a more diversified one. Hence, Goldman proposes that the equally weighted S&P 500 might outperform the standard index over the next decade. Eliminating the concentration effect could result in improved risk-adjusted returns, even if the largest companies continue thriving. Let's review the other risks Goldman outlines in their report. A primary concern revolves around U.S. government debt. The debt to GDP ratio keeps climbing, with Goldman projecting no reversal. They enumerate policy options to address the trajectory, such as tax hikes, spending reductions, and entitlement reforms, but don't foresee these occurring. Increasing debt introduces several dangers. Higher interest payments limit other government expenditures, and increased Treasury issuance competes with corporate borrowing. Eventually, investors may seek higher yields to acquire U.S. debt, pushing rates up across the board. Goldman isn't forecasting a debt crisis, but flagging it as a lingering risk that could surface if a catalyst prompts reevaluating U.S. creditworthiness. Another key risk involves China, particularly supply chain dependencies. Goldman notes that China commands nearly 70% of rare earth mining, 92% of rare earth refining, and 94% of global magnet production. These materials are crucial for electronics, electric vehicles, and defense purposes. Furthermore, the pharmaceutical supply chains heavily rely on Chinese precursors. This reliance introduces a vulnerability that has already been evident amid trade tensions, with potential for further escalation. The third major risk pertains to the uncertainty surrounding monetary policy. According to Goldman, the current environment is characterized by a mix of monetary policies as central banks globally are taking different paths. The Federal Reserve has started lowering rates, but the future course remains ambiguous. While some Fed officials anticipate more cuts, others expect rates to stay stable. This lack of clarity brings volatility risks. Markets have grown accustomed to the Fed stepping in during downturns. If inflation worries constrain the Fed's rate-cutting ability during an economic slowdown, that assumption could be challenged. The fourth major risk includes what Goldman terms as localized vulnerabilities worldwide. Political instability in different regions, banking issues in specific countries, and real estate challenges in certain markets could have spillover effects even if the U.S. economy stays robust. Now, I'll delve into what I found most insightful in Goldman's report, their investment philosophy section. Goldman highlights 5 key elements of their strategy: learning from history, suitable diversification, a value based approach, setting appropriate time horizons, and maintaining consistency. These elements are anchored by effective asset allocation. What strikes me about this framework is its simplicity compared to the thrill of predicting crashes and making bold forecasting claims. Nevertheless, Goldman's research team, considered one of the most advanced globally, bases their strategy on these straightforward principles. They provide a chart illustrating the cost of missing the top performing days in the market. Since March 2009, being fully invested yielded nearly 17% annual returns. Missing just the 10 best days reduced returns to 12%. Missing the 25 best days slashed returns by half. The best days frequently occur amid highly volatile times when investors are most tempted to exit. Those who panicked during COVID missed some of the strongest market days. Those who withdrew during the 2022 slump miss the subsequent recovery. Goldman's implicit message is evident. Trying to perfectly time market crashes tends to destroy more wealth than enduring the crashes themselves. The cost of mistiming market declines outweighs the benefits of remaining invested through market fluctuations. Let me distill what Goldman's report signifies for various investor categories. For long term investors with a 20-plus year outlook, Goldman's message is simple: remain invested. Avoid trying to predict corrections. Acknowledge that while the next decade may yield lower returns than the previous one, they will still be positive. Consider broadening investments beyond U.S. large cap stocks to seize potential gains in other areas. For medium term investors with a 7 to 15-year outlook, Goldman's alerts require more caution. Achieving 6 to 7% returns over a decade instead of 13% implies slower portfolio growth than anticipated. Reevaluate projections and consider if saving more, working longer, or adjusting expectations is necessary. For those nearing retirement within 5 years, the concentration risk highlighted by Goldman is crucial. An S&P 500 weighted portfolio actually resembles a concentrated gamble on 10 companies. Evaluate if such concentration aligns with your risk tolerance at this stage in life. For retirees drawing from their portfolios, Goldman's forecast of lower yet positive returns is relatively reassuring. While the risk of withdrawing during a downturn is present, Goldman doesn't foresee a severe crash that would heighten that risk. Here's my personal takeaway from Goldman's report. First, I'm not altering my long-term approach due to valuation worries. Goldman's data reveals that markets can remain expensive for extended periods while still generating positive returns. Historically, the opportunity cost of holding cash waiting for a downturn surpasses the cost of weathering corrections. Second, I am focusing more on concentration issues. The fact that 40% of the index is concentrated in 10 stocks worries me, not due to any fault of those companies, but because it increases correlated risk. I'm diversifying more towards equal weight strategies and international markets. Third, I'm mentally extending my time horizon. If Goldman is correct that the next decade might yield 6 to 7% annual returns instead of 13%, I need to realign expectations. This still equates to positive compounding, albeit at a more moderate pace than recent years suggest. Lastly, I'm keeping larger cash reserves than I would in an environment with lower valuations. It's not that I'm anticipating a market crash. Having cash on hand during turbulent times enables me to adjust my portfolio as opportunities arise, rather than selling when it's unfavorable. I'm also choosing to disregard crash predictions. Goldman's assessment points towards ongoing growth with substantial risks, not a market collapse. I'm steering clear of overreacting to misinterpretations about what expert analysts believe. Let's touch on a key issue within the crash prediction industry: fear sells. Headlines that hint at a crash may garner millions of views, while those implying modest returns, like a 7% forecast from Goldman, don't attract the same attention. This trend in financial media leads to an exaggeration of threats. It creates a disconnect between analysts' actual reports and how the media portrays them. Goldman's analysis is prudently optimistic, analyzing risks thoroughly, yet the coverage often suggests they foresee a catastrophe. I've seen this cycle unfold repeatedly, with reports being sensationalized. If investors glean only from headlines, they might get an inaccurate impression of the analyst's actual views. Addressing risks shouldn't be ignored, but understanding them within their true context is key. Risks highlighted by Goldman, like high valuations, concentrated markets, increasing debt, and ongoing geopolitical issues, reduce expected returns and increase volatility, but they don't predict an impending crisis. Responding appropriately to this distinction is crucial. Here's my approach to analyzing reports like Goldman's. First, whenever possible, Dig into the primary sources rather than mere summaries. Goldman's expansive report, accessible online, offers far more depth than any snapshot summary can. Second, differentiate between base scenarios and risk scenarios. Goldman's baseline prediction suggests 7% returns with a 25% chance of recession, but the media often blurs these lines. Third, consider the motivations. Goldman aims for its clients' sustained investment and growth and has no reason to fabricate a rosy outlook or unnecessary panic. Genuine concerns expressed by them don't imply alarm. Fourth, concentrate on strategic actions over forecasts. What are Goldman's pragmatic recommendations? They stress remaining invested, diversifying, extending investment timelines, and adapting to lower expected returns rather than engaging in hasty selling or substantial repositioning. Lastly, remember that forecasts are probabilities, not guarantees. Goldman isn't asserting a 7% return definitively. It's their best projection given the current data. Actual returns will vary, potentially significantly. A crucial insight from Goldman's report is the chart depicting cumulative returns since their 2021 outlook. The U.S. market has nearly doubled at 99%. Non-U.S. developed markets showed 60% growth. Emerging markets had a 24% increase, while China saw a 14% drop. 5 years ago, no one could have foreseen the pandemic, inflation surge, the Ukraine conflict, or the AI boom, all impacting these returns. Yet, the core strategy, staying invested and diversifying, has yielded solid results despite uncertainties. The next 5 years will undeniably bring unforeseen developments, some positive, some negative, and neither Goldman nor anyone else knows what they will be. What they do understand is that long-term investment in productive assets consistently trumps timing disasters. This observation underscores wealth building rather than any specific forecast for 2026. Investors who, 5 years from now, will regret panicking are likely consuming crash content at the moment. Those who will reflect with satisfaction are probably delving into detailed reports, grasping subtleties, and adhering to their long-term plans. Goldman isn't guaranteeing market gains. They're stating that despite actual risks, the default outlook remains positive growth, and the best tactic is steady investment. It's not as thrilling as crash forecasts, lacking the same emotive pull, but it represents the authentic posture and advice from seasoned analysts. You have the choice of which version of events to heed. Just be sure you comprehend Goldman's actual messages before deciding on your course of action.